Welcome to Paycheck for Life, a Sarah's new and mid-career employee webinar. In this webinar, we're assuming that you're either new or you're somewhere in the middle of your career, which is why we named it that. The bottom line there is that you're not yet near retirement, which in the context of this webinar is a good thing because it means you still have plenty of time to plan for your retirement. So in this webinar, I'm going to tell you all the things that you might want to know about doing that planning. And since you're curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if I need to do something, what is it? So I think I know about 95% of the questions that you're going to ask already because I've been doing this for a while. And I've arranged the answers to what I think you're going to ask in the form of this checklist. So this is what we're going to go through during the presentation. So I'm going to help you understand a few retirement basics regarding a SARA. We'll talk a little bit about pension math. It's not complicated. If you are allergic to math, don't worry. It's super simple. As part of that discussion, I'll tell you a little bit about Sarah's retirement formula. We'll talk about purchasing service credit. And then I will help you get a pension estimate. I'm going to show you how to get a precision pension estimate using the benefit estimator tool on our website when you log into your personal account. I will help you understand when you become eligible to retire in the future. I will talk about some additional benefits that we offer. I will help you designate your beneficiary, or beneficiaries for the death benefits that we offer. And then I'll talk about some career planning options. And what I mean by that is that at some point in the future, you're going to stop working here. And what will your options be regarding your Acera account and your retirement plan when you leave this job, whether you're going to a different job or whether you're going into retirement? And that will flow right into the last discussion, which is making a retirement planning picture. So we're going to take a little peek into the future and help you figure out how to get to a comfortable retirement by the time it's time. And as part of that discussion, we'll talk about starting a 457B account. And that whole thing will take us about until noon. Okay, so let's jump right in. Let me help you understand some retirement basics. First off, let me tell you about who is a SARA. A SARA, in one sense, is this acronym, the Alameda County Employees Retirement Association. There are about 90 of us, 90 plus of us that work at a SARA. We're all county employees, like many of you, and our entire job is to provide retirement, disability, and death benefits to our members. So that is you. You are the part of the who that is a SARA because you're a member of a SARA. And you're a member of a SARA because of the position that you work in and who you work for. Okay? You work in a retirement eligible position, and at least at the start of that retirement eligible position, you worked full time. Now, you can begin your full time retirement eligible position and then go down to less than full time later. That's totally fine. You can maintain your SARA membership. But at least at the beginning, you worked full time in that retirement eligible position for one of the 6 public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work for one of these 6 places in that retirement eligible position, you are automatically an Acera member. And in fact, your membership is mandatory, so you have no choice. So as an Acera member, with every paycheck that you receive, you pay an employee contribution into Acera's fund. So if you look at your paycheck, you'll see a line in the before tax deductions column, or maybe it'll say pre-tax deductions column. The different employers have different pay stubs. And you'll see a line in any case that says something like retirement or Acera. And you'll see money coming out of your check. And that money goes into Acera's fund, which with each paycheck that you receive, and that is your employee contribution. And every time that happens, your employer makes a contribution on your behalf. So you're both paying into the fund, and then don't want that money to just sit around and collect dust, so we invest it in a diverse array of investments all over the world with the goal of earning interest, and we do, over long periods of time, earn a significant amount of interest. So it's these 3 sources of income that give us this big pot of money that we call the Sarah's Fund. So why are we doing this? Why are we collecting all this money? Why are we investing the money to earn more money? What are we going to do with this money? Well, you are working in your retirement eligible position. And as you work throughout your entire career, you earn more and more credit in that position the longer that you work. You earn credit in three different categories, which I'll talk about in a minute when I talk about the retirement formula. Okay. But essentially, the longer you work, the more credit you earn toward retirement. And at some point in the future, you are going to retire from Acera and you're going to stop earning credit toward retirement and you're going to start collecting the retirement that you have been earning throughout your entire career in the form of this monthly retirement allowance for life. So we pay you your monthly retirement allowance every month for the rest of your life. You cannot outlive your retirement allowance. It's kind of amazing. So that's why we are collecting and investing the money is because we are going to have to pay you a lifetime retirement allowance once it comes time for you to retire. And when I say it's kind of amazing, pensions are special. Okay. The public sector, I'm sorry, the private sector doesn't do this much anymore. It's mostly public sector agencies. And it's special for one, because it is a guaranteed income for life that you can plan on. Okay. So it's based on a formula. And once I show you the formula, and you don't even have to remember the formula, you can use the benefit estimator, the retirement calculator in your account on our website when you log in. And you can get very precise projections of what that monthly payment is going to be after you retire, that you will receive for the rest of your life. And it's guaranteed income, so you can count on it for the rest of your life. It's always going to be there. So that's kind of amazing. And it helps you do that retirement planning because of the guaranteed part of it. You can count on that guaranteed income when it comes time. Additionally, one other thing that I'd like to point out is that the way that everything works is that once we start paying you that monthly income, we're essentially going to give you back all your money that you paid into the system within the first 3 to 5 years of retirement. And then everything after that, it's almost like this amazing bonus. But really, it's the employer contributions and the investment earnings that pay for the vast majority of your lifetime retirement. That's just how pensions work. So it's kind of amazing. Everything that you paid into the system, you're going to get back within your first 3 to 5 retired years. Um, so you end up collecting in retirement on average, a much higher significant amount of money than you paid into the system. Okay, so that's kind of basically how a Sarah works. Now, let me show you this milestone chart. And I think what this will do is help illuminate some of the details that I'm going to give you about the nuts and bolts of how a Sarah works. So it's good to give you some context for that straight away. Okay, so these are some of the milestones, if not all of the milestones, that you will experience with your membership with a Sarah. The first milestone is your date of hire. This is your first day of work in that full-time retirement eligible position. Okay, then 2 weeks goes by, and the first day of your second pay period is your first day of membership in Acera. This is also known as your date of entry in Acera. This is when you start earning credit toward retirement. Now, for 2 of our 6 employers, there's actually no 2 week lag. For Livermore Area Recreation Park District and the Housing Authority, your date of hire is your first day of Acera membership, but for everyone else, there's a 2 week lag. Okay, now you're an Acera member, what happens? Well, you start earning credit toward retirement as you work. One of the 3 categories that you earn credit in is called service credit, and it's basically time worked. So if you work full time for 5 years or the equivalent of full time for 5 years, you would earn 5 years of service credit. And once you have earned 5 years of service credit, you are considered vested in Acera, vested in the pension system. Okay. Vesting it's kind of a loose term. It kind of means guaranteed. So once you're vested in the system, you start being able to access the vested benefits, the guaranteed benefits. And you'll see kind of how that works a little bit later on when we talk about the details of when you can start collecting the benefits. Okay. And one more side note I want to make is that I said the word pension, and so this slide is titled Pension Milestones. On the previous slide, the one before last, I talked about your lifetime monthly retirement allowance. These are all synonyms for this same concept. Okay, so I might say retirement allowance, pension allowance, pension benefit, retirement benefit, monthly retirement allowance, lifetime monthly allowance. These are all synonyms for this idea that we're going to pay you every month for the rest of your life the retirement that you've earned once you retire. And when can you actually retire? First, what's the first time that you can retire? Well, it's when you become retirement eligible. And it's through some combination of your years of service credit and your age. And there's a few different combinations that will get you there. I'll show you what those are a little bit later on. But this would be the first day that you could physically retire from a SARA. Now, many people do not retire on this day. Many people continue working because the longer you work, the more credit you earn toward retirement, and the higher that retirement allowance is going to be once you retire. And so that's why I put a gap in between um, the retirement eligibility and when this example is actually leaving work. Okay, so the next milestone is your termination date. This is when you leave your job. This is your last day on payroll. This is when you stop earning service credit. And many people will go straight from active service in their job into retirement from a SARA. And the next milestone is your retirement date, which is a date that you choose. Now, that's not necessarily the case. Okay. It happens a lot. It happens the majority of the time, but not always. So because it happens the majority of the time, that's why I kind of have overlapped these two because they often happen one day after the other. But you may not be planning on that. You may be planning on leaving your job and deferring your retirement to a later date. And in which case there would be a gap between these two milestones. That's perfectly fine. I'll talk about what your options are if you were to do that when I talk about the career planning in the second half of the presentation. Okay, so now you're retired. What happens? Well, like I said, we pay you your pension benefit, your lifetime monthly retirement allowance every month for the rest of your life until your death. And that's when your retirement payments stop. And there's one more milestone on the chart, which is that at the time of retirement, you can name a beneficiary for a continuing payment known as a continuance. And in most cases, it's for the rest of their life. And so once after your death, once your beneficiaries dies, at your beneficiary's death is when their payments would stop, and that would conclude a SARA paying out all the benefits we owe to you and your beneficiaries. Okay, so next, moving on. Let me say a couple more quick words about vesting, the guarantee part, because vesting, I said, kind of means guaranteed. Like I said, it happens at 5 years of service credit. Once you earn 5 years of service credit, basically 5 years of timed work, but that includes reciprocal service credit. What does that mean? Well, reciprocity is when you link more than one California pension system together to get some synergistic effects. And I will go into detail about that in the second half of the presentation when I talk about career planning options. But I just wanted to mention that if you do have service credit with another pension system and you link it together with a SARA, we look at all of the service credit combined among all of the systems you have linked together to determine whether you're vested. And then all of the systems would consider you vested once you have a combination of 5 years among all of them. And then the guarantee, where does the guarantee come from? It comes from state law. So this is the 1937 Act. It tells us how to do everything at a SARA, how to calculate everything, how to run everything. And the vested benefits, the guaranteed benefits, are that lifetime monthly retirement benefit, that retirement allowance you get for the rest of your life once you retire from a SARA, an annual cost of living adjustment, which is a percentage increase annually in retirement to that retirement allowance, and a $1,000 lump sum death benefit. And there are some other death benefits available to your beneficiaries as well. Let me check on these questions here. Okay, I will get to the beneficiary question a little bit later when I talk about death benefits. And then somebody's asking when I have a designated time to retire, what time should I start the retirement paperwork? How many months before my retirement date? We ask that you schedule a retirement ready to retire counseling session. These are the only counseling sessions we do one-on-one. About 3 to 6 months before your retirement date, and then you complete the paperwork within the 3 month period before your retirement date. So you don't have to do any of that stuff until your retirement is much closer. Okay, let me tell you about your tier. You're all in one of these tiers, and it depends on when you entered a SARA. So it's based on your first day of membership in a SARA, your date of entry. To find which timeline to look at, first off, if you're a safety member, you're looking at the bottom timeline. Safety members are sheriff's deputies and probation officers. Okay, so you're looking down here. Now, everyone who's not a safety member is a general member. So if you're a general member, you're looking at the top timeline. Unless you're a general member who works for the housing authority, then you're looking at this timeline, or you're a general member who works for a Livermore Area Recreation and Park District, and then you're looking at this timeline for your employer. Okay. The way this works is that if you entered a Sarah before the cutoff date for the tier, that would have put you in the earlier tier. So if you entered a Sarah before July 1st, 1983 as a general member, that would have put you in tier one. There's not a lot of tier one members left who haven't retired because that was a long time ago. So if you entered a Sarah July 1st, 1983, all the way up to December 31st, 2012, that would have put you in tier two. If you entered a Sarah January 1st, 2013 and beyond, that would have put you in tier four. And that is the case with all of the timelines. You'll note that the Housing Authority has a different tier one cutoff date. LARPD does not have a tier two, they have a tier three, and they have a different tier one cutoff date. And the safety members have three tier twos. And if you entered as a safety member between October 17th, 2010 and December 31st, 2012, you had a choice between these two tier twos whenever within your first 45 days of that safety membership. And if you didn't pick, then you were defaulted into one of the tiers. Now, the differences between the tiers is that when we go to calculate your retirement in the future, the calculations are slightly different, and there's a slightly different rules among the tiers. And so I'll talk about all that as I go through the different details of how the plan works. And one more thing I want to point out about this is that if you do have reciprocity with another pension system and you have linked the pension systems together, that could put you in the earlier tier if you do establish reciprocity, because we would use the date of entry into the first system that's linked together. So if you want to read more about that, you can visit acera.org/tier or acera.org/reciprocity. And there are details there about that. Okay, and one more, and the last thing I want to say about the tiers and the date of entry is that if you don't remember your date of entry or you don't know which tier you're in, the easiest solution for that, it will tell you exactly both of those things, is to log into your account on our website. So once you get in there, you'll see your tier, your date of entry, how many employee contributions you've made to the system, how much service credit you've earned so far. There's a lot of other details, and that's where the benefit estimate tool is that gives you the ability to make precision benefit estimates for the future. So you definitely need to create a login for there. I'll show you where to go to do that. So here is our website, acera.org. So you navigate to acera.org. From every page on the website, you'll see this login sign up button. Go ahead and click that. Now, if you have logged in here in the last about year and a half, since I think November of 2024, that means that you have already created a login for this new system that we launched then. And all you need to do is put in your username and password, click login. Okay, now if you forgot your username or forgot your password, you can use the forgot username or forgot password link down there. Somebody asked a question, I forgot my username, let me see. And I enter my personal email and SSN, but I haven't received an email. Does it take time to verify my account? You should receive it pretty instantaneously, if not within the first 10 minutes. It's is possible you used a different email whenever you logged in, so you may want to try using that different email. And yeah, it looks like if you, yeah, it's asking you for email and SSN on this one. So yeah, try a different email. If you do, look in your junk email, look in sometimes Gmail. If you have a Gmail account, we'll sort it into like deprioritized inbox. So look at all mail. If you're looking at it through Outlook, sometimes there's like a other tab that so you got to look in all those tabs and see if you can find it. If you do need help, go ahead and give us a call 510 628 3000. I'll type that in. And we do have a call center that they help people through that stuff all the time. Okay. Now, if you've never logged in, or if you haven't logged in that time period since November 2024, we deleted all of the old logins from the old system because we wanted you to create a fresh one for security purposes. So what you all are going to need to do is you click the enroll button. And let me just take an aside here. Okay, since this is a new employee slash mid-career webinar, if you're brand new, and you have just started your job and you're within your first 7 weeks of your job, you can't log in yet because an account has not been created yet. So what you will need to do is wait for Sarah to send you the welcome letter that we're going to send you. It happens about 7 weeks after you start your job, and in the welcome letter, there will be instructions on how to create your account. But for everyone else who's already been here more than 7 weeks, you're going to, again, navigate to acera.org. Let me go back here. Click the login button, click the enroll link. And to enroll, you're going to need an enrollment pin. So it's not instantaneous. You need to request an enrollment pin by clicking the link. Then you put in your info and you hit request pin, and this generates a letter on our side. We'll send you the letter within a few days. We'll get it right in the mail to you. So it does take a few days to receive that in the mail. We do that for extra security. Sorry, it takes a few days before you can get in there. But there's a lot of financial information in there, so we just want to make sure that it's the Acera member that is logging in and that your account hasn't been compromised. If you have any problems with this, like you get an error message, I recommend trying an earlier zip code because you may not have updated your address, or it just may be an old address in the system. So try your last zip code or the zip code before that and then see if it works. So that may be the problem. And the same goes for the enrollment screen. If you have problems here, try an old zip code. And somebody said that they had a problem logging in. They had to get a new PIN. That could happen too. So our my colleagues may direct you to they may generate a new PIN for you to create a new login for you. So sorry if you have to wait on that. Okay. And the rest of the questions I will get to later because I will talk about that stuff. So once you do log in there, after you create your username and password, you can see which tier you're in, your date of entry, and a lot of other stuff, and use the benefit estimator. Okay, at this point in the webinar, I want to give you some context for the entire discussion that we're having. So this is kind of the shape of the discussion. Because I'm here to help you do retirement planning, to take a little bit of a peek into the future, okay? So it's really good that you're here because we can have this discussion now while you still have time. Okay, so what we're going to do is at the end of the presentation, I'm going to revisit this slide. And what I'm going to do for most of the presentation is talk about how your Acera pension works. Okay, and the reason I'm going to do that is because this equation is kind of a picture of your future retirement income. So if you think into the future, far into the future or close into the future for maybe some of you, when you might retire and when you might stop working, you are going to stop receiving a paycheck from your employer. So you're going to need income to pay for your life in retirement. Where is that income going to come from? Well, if you've earned enough credit with Acera, you can collect your Acera pension by retiring from Acera, which we kind of call paycheck for life. So you stop getting your employer's paycheck, and Acera starts giving you your paycheck for the rest of your life in the form of your Acera pension. If you have any other pensions from previous jobs that you've had, you can kind of put that into this category as well. So that's one source of retirement income. The second source of retirement income is Social Security. So all the general members, everyone who is not a sheriff's deputy or a probation officer, you are paying into the Social Security system. And if you pay into the Social Security system for at least 10 years, and it doesn't have to be in a row, it can be, mix and match here and there, you will get to collect Social Security one day. The earliest is age 62. We'll talk about that a little bit later. But you can collect that and you can add that to your future retirement income. If you are a safety member, maybe you have some previous work that got you over the 10-year mark that would allow you to collect a Social Security payment. Okay. So you got your Acera pension, your Social Security income. Everything beyond that is going to be your personal savings and investments. And financial planners will tell you that in order to maintain your standard of living in retirement, you are going to need to replace 80% of your working salary from your job that you're working right before you retire. You're going to need to replace that salary with retirement income from a combination of these categories. Okay. How are you going to do that? Well, that might sound nerve-wracking right now. Whenever I think about it, I get nervous. Maybe everyone else has a different constitution, but I'm going to walk you through it step by step at the end of the presentation. And I think you'll find that it's actually super easy to figure out whether you're pointed in the 80% income replacement trajectory. Because we're going to get projections of your Sarah pension, Social Security, and then we're going to figure out using technology if you need to save more, how much, and where to save it. Okay, so we'll talk about all of that. But I wanted to give you some context for the entire discussion because that's what we're working toward. Now, what I'm going to do is I'm going to talk about a lot about how the Acera pension works, and that will help you figure out how to dial in the Acera pension, how to make sure that it's the max. Okay, because you have a few levers that you can dial it in with. Not as much as the levers that you're going to find out that you have with your personal savings, but you do have some levers that you can dial in the Acera pension to make sure that it's the max. So that's what we're going to talk about first. So let's go ahead and move to that discussion. Okay, so our next topic is understanding a little bit about pension math. So understanding a little bit about how a Acera works. Okay. So here is a Sarah's retirement formula that way in the future, when you go to retire, we're going to use this formula to determine what we're going to pay you every month for the rest of your life. Okay. Now, if your eyes are glazing over because that's a long way away and or you don't like math, don't worry. Okay. The reason that I'm explaining this, and I won't spend a ton of time on this slide, is because I think you'll find that if I tell you how we calculate each one of these numbers now, even though this isn't going to really apply to you until you retire, we're not going to do the calculation until you retire. If I tell you how we calculate each one of these numbers, it will help you dial in this monthly retirement allowance and will help you understand how we get to it. And then whenever you get your benefit projections from our calculator in your account on our website, you'll understand all of the things that go into that and then how to crank that up. Okay. So, so this is a simple multiplication. Let me just walk you through it real quick. Okay. So in retirement, if you think into the future, when you go to retire, you are going to get a percentage of your highest salary for each year of service that you work. Okay. This sentence is saying in English what this multiplication is doing. Okay. So you're going to get a percentage of your highest salary from anywhere in your career for each year of service that you work. So let me plug some numbers in here and I think it will help illuminate this. Okay. Let's say, for example, that the percentage of your highest salary that you are going to get for each year of service from Acera when you retire is 2%. So I'm going to plug that into the age factor percentage spot here. So it's 2%. You're going to get 2% of your highest salary for each year of service. And let's also say, for the sake of this example, that when you go to retire, you worked for 20 years. So you earned exactly 20 years of service with Acera. So I'm going to plug the 20 years into the service credit slot here. Okay, now what this means is that you're going to get 2% of your highest salary for each individual one of these 20 years of service. So the longer you work, the more years, the more of these percentages we're going to add to it. Okay. In this example, we're adding up 2%. So essentially, we're taking 2% plus 2% plus 2% plus 2% 20 times. So we're multiplying them together. 2% times 20 is 40%. Okay. So now we know that your retirement allowance is going to be 40% of whatever your highest salary was while you were still working. So now to finish out the equation, let's say, for example, that your highest salary when you were working was $5,000 per month. So 40% of $5,000 when we finish multiplying it out is $2,000. So this becomes what we pay you every month for the rest of your life, this $2,000 in this example. So you're replacing, in this example, 40% of your working salary with your retirement allowance. And that's actually pretty good. When you add the Social Security and the savings to that, that's a pretty solid retirement. Okay. And we'll talk about that later, like I said. So the bottom line here, if you take one thing away from this, is that the higher any of these three numbers are, because it's a multiplication, the higher the age factor percentage, the higher the years of service, the higher the salary, equals a higher monthly retirement allowance for life. So the way that you maximize the retirement allowance is maximizing each of these three numbers. The way that you maximize the age factor percent, actually, let me just show you. I'll just walk you through how we calculate each one, and you'll be able to figure out how you get the maximum for each one. Okay, so first off, let me show you how you maximize the age factor percentage and what the percentage is going to be, how we figure it out. Because somebody's asking, how do you know your percentage? Because it's not necessarily going to be 2%. That was just an example. Okay, so what is the percentage going to be when you go to retire? Well, the percentage is going to be based on these age factor percentages that come out of the state law for your tier. So all of these are codified in state law, and you're just going to look at the column for your tier. So a lot of people are probably general tier 4 members, so you would just look at this column and you forget about the other columns. They do not apply to you. And because these are codified in state law, these numbers don't change, okay? If you're a safety member, you're looking over on this half for your tier. If you're a general member, you're looking at this half for your tier. Okay, so let's say, for example, that you retire at age 60 as a general tier 4 member. Well, you can see those intersect age 60, tier 4, general, at 1.80%. So that's how we figure out which percent to plug in to the age factor percentage slot here. It's based on your age at retirement. So that's kind of the way that you maximize this number. It kind of goes hand in hand with the service credit. The longer you work, the more service credit you will earn, and the older you will retire. And so the age factor percentage goes up and up and up the older you are retire when you retire. And it actually increases with every quarter year you age. So these are just some examples of a few of the percentages. But if this were the full chart, and you can see that chart on our website at acer.org/age, the full chart would say 52, 52 and a quarter, 52 and a half, 52 and three quarters, 53, 53 and a quarter, and so on and so forth. And you get a slightly higher age factor percentage every time you age a quarter year. Okay. And so we use whatever the age factor percentage is for your age at retirement. And you'll note that the percentages max out wherever the blue box is. So if you're a Tier 4 general member, it maxes out at 2.50% at age 67. If you retire 68 or 69 or 79, you still get the 2.50% max in the formula for you. Okay, so the bottom line here, because I just gave you a lot of details about the age factor percentage, if you don't want to, oh, and somebody's asking before I move on to that. Somebody's asking, why do some percentages have a higher max than others? It is because the state law, there's various code sections in the law that created these tiers, and then it was historically before Tier 4, before 2013, historically it was the employer that adopted the code section that created the tier and that set the set of percentages. So there was various points in history where some of the people negotiated tiers with higher percentages, especially safety members, because they don't get to collect Social Security. So they were able to negotiate the higher percentages that are paid out of the pension fund to make up for the Social Security they don't get to collect. And so that's the historic reason. Then 2012 came around, the state passed the Pension Reform Act, which created Tier 4 for everyone across the board. And so this is the set of percentages for Tier 4 general and for Tier 4 safety, and that's kind of standardized across the state now. So that was the reason for that. And they did the Pension Reform Act because they were trying to kind of dial down a little bit the public liability for pensions without trying to decrease them too much. You'll notice that Tier 4 does max out higher than Tier 2, which was the previous one that people would go into, but you got to wait a little bit longer. And somebody's asking, will these percentages ever increase? They probably will not. These percentages will never change, and the likelihood that the state will pass some kind of legislation that would create another tier option that has higher percentages, I mean, this is purely my wild guess, my wild opinion based on observing this for many years. I bet that there is not an appetite for that in the state uh, legislature anytime soon. And somebody's asking, what if you have reciprocity and you have the 2.7% at 55? Will that only apply to that retirement system? So you are asking about the safety tier 4 tier. So if you have reciprocity, it's possible you could have gone into an earlier tier. Or if you do establish reciprocity, that could put you in an earlier tier. So you, if it's before the cutoff dates for the tier, and that would apply to Acera. So we would put you in an earlier tier. You would have to check with the other pension system to see what tier you're in over there. So that would be a question for them. But if you do want to read about that, if you go to Acera, let me type that in for you, acera.org/tier. It will talk about the different cutoff dates and the rules for getting into an earlier tier with reciprocity. Okay, so that's the age factor percentage stuff. That's a lot of info. The bottom line there, an older retirement age equals a higher age factor percentage up to the max for your tier. So if you forget about all the other stuff I told you, just remember that part. Okay, let me tell you how service credit is calculated. Service credit, like I said, is basically time worked. You start earning service credit when you enter Acera, and you're going to earn it all the way up until you terminate employment with your Acera covered employer, one of our 6 participating employers. Okay. You earn service credit during your regular work hours. That makes sense. But you also earn service credit during your earned leave times, which include earned vacation leave, sick leave, if you get management leave, if you have some comp time that you earn, holidays and floating holidays. Whenever you mark any of these leave times on your timesheet, you earn service credit during that time. So it doesn't count against you for the purposes of earning service credit. Now, you do not earn service credit ever because of leave without pay during that time. If you're not getting a paycheck from your employer, you're not earning service credit. Also, if you purchase extra vacation on top of your earned vacation, some of our employers allow that. When you mark the purchase vacation on your timesheet, you're not earning service credit. Also, additionally, sold vacation. This is slightly different. Some of our employers allow you to take your earned vacation and sell it back to them for cash. You don't go out on the vacation, you're just selling the time back for extra cash. You don't earn service credit if you sell back your vacation time. Also, overtime, on-call time, and standby time do not count toward earning service credit. So you don't earn service credit during those types of time. And let me just check the questions here. Okay, so looks like all the questions I'm gonna get to, so I will definitely get to them. Okay, so now we know how you earn service. So one of the ways that you increase your and max out your Acera retirement allowance is by earning more and more service credit. So working longer. But there's another way. You can purchase additional service credit to increase the amount of service credit that we will calculate in the formula for you. And because the service credit is a multiplier in the formula, putting more service credit in the calculation increases your retirement allowance. So if you purchase service credit, it makes your retirement allowance go up. Okay. Now you can't just buy what they call airtime, which is I want to buy another year, so I'm just going to buy it. The law does not allow for that. But it does allow for you to purchase time in these categories, and the it's basically time worked before you achieved your retirement eligible position or gaps in time during your active membership is kind of the two broad categories. Okay. So let me walk through each one of these in detail so you can understand, because some of you may have some of this type of time already that you can buy. And if you do, I'll talk about how much it costs, how to make the service credit purchase, how to decide whether you want to make the service credit purchase or not, and when the best time to do it is, which is always as soon as possible. So I'll go through all that. Okay. So first off, you have this category here. Oh, and I just wanted to say one more thing is even if you don't have one of these types of time, it's good to know, it's good to like kind of process what these all are because you may incur one of these types of time in the future, and you'll see that as soon as you incur it, the best time to purchase it is as soon as you can. Okay. So here are the types of eligible service credit purchases. Okay. So you have this broad category is kind of time worked before your full-time retirement eligible position. Now, time that you worked for an employment agency, a temp agency, or under contract is not purchasable. So part-time work, this part-time work here, that is not through one of those things. That's just plain old part-time work that you did for your employer before your full-time retirement eligible position. That's purchasable. Also, temporary assignment pool time. This is the county's temporary assignment pool. All that time is purchasable. That's what TAP stands for. Seasonal, intermittent, service as needed, project, per diem work, those are all purchasable. So all of those designations of time worked before your full-time retirement eligible position is purchasable. Okay, then we move up to the days between the date of hire and the entry date. That 2 week lag time, that is purchasable. And somebody had asked about that. So let me just make sure that was the full answer to that question. Somebody said, "Is it true you can pay your first 2 weeks of work so your Sarah can start?" It's not that your entry date goes back. None of these purchases change your entry date, but they just increase the service credit number we put in the calculator for you. Okay, but yes, you can buy that 2 week lag. Okay, then we have unpaid medical leave. So the next three are kind of these leave times that you incur during your active membership. So we got an unpaid medical leave. This is for your medical condition only. So you go out on the medical leave, okay? Maybe you burn through all your sick leave, all your vacation leave, all the other types of leave, and then you're just out on unpaid medical leave, but you still have a job, okay? Once you return from that unpaid medical leave, the part where you weren't using your accruals because you already got service credit for that time, the part where you were just on unpaid medical leave, that's purchasable up to 1 year per instance of the unpaid medical leave. So as soon as you return from the medical leave and receive one paycheck, you're considered back from the medical leave and you can initiate that service credit purchase. And somebody asked about FMLA. FMLA stands for the Family Medical Leave Act. That is the federal law that says that basically your employer can't fire you because you're out on medical leave for up to 12 weeks. Okay. Um, and so if you are out on a leave time for a medical condition for yourself, it may be that that is designated as FMLA for the purposes of making sure that that law is followed. But part of that time you could be using your accruals, so that wouldn't be purchasable. But part of the time you may not, it may be unpaid, and that part of the time would become purchasable upon return. And one more thing I want to say, like I said, it's your medical condition only. So maternity leave counts if you're on unpaid maternity leave, but paternity leave does not count because the county has not adopted that code section yet. So hopefully they will do that at some point in the future. But it as it stands, it has to be for your medical condition. And that's my understanding of why it's like that. So somebody had asked about the maternity leave, so we answered that question. Let's see here. Somebody asked about FMLA, we answered that question. Somebody's asking, what did you say about the days between the hire date and entry date? That 2 weeks is purchasable. So if you purchase that 2 weeks because you didn't earn service credit for it until your entry date, that's purchasable. That will increase your service credit by 2 weeks. So that is purchasable. Um, Somebody says for unpaid medical leave up to 1 year, does that mean you need to purchase a service credit within 1 year after return? No, it does not. It means 1 year of unpaid medical leave. So if you're out on unpaid medical leave for a year and a half and you return from that unpaid medical leave, you can buy a year of that year and a half that you were out because the limit is 1 year. Now, if you go back out on another unpaid medical leave and you're out for another year and you come back, you can buy that year too. It's just 1 year per instance. The deadline to purchase, somebody's asking about the deadline to purchase service credit, is you have to purchase it before you retire. That's the only deadline, except for the military leave. It has a special deadline. You can read more about that at acera.org/service. Okay. So that purchase is sooner. Now, the state disability insurance leave is when you are temporarily disabled, you can't perform your job duties, so you're out on state disability insurance leave or workers' comp leave. Sometimes what happens is you're paid from the state's disability insurance or workers' comp system partially, and you're paid partially by your employer. For the part of it that you're partially paid by your employer, you will already have earned service credit for that time, and so you would just need to purchase the unpaid part of that time when you return from that. The military leave during membership, that is not prior military service. That is where you're actively working. You go out on military leave, you return from that military leave, you can make that purchase upon return. Okay. Let me finish out this list before I check because I see a bunch of questions popping up. Let me just finish out this list and then I'll answer the questions. Okay. Redeposits of prior memberships. This is where you used to be an Acera member in the past. You were working for one of our six employers, you were paying into the system, you were earning service credit, you stopped working for that employer, and when you did that, you took a refund of your employee contribution account. And when you did that, you lost your service credit. Okay, and you went and did something else. Now you're back here and you're working here again and you're an Acera member again. If you want your original service credit back from that original time worked, you can redeposit an equivalent amount of money, and that will allow you to get that original service credit back. That's called a redeposit of a prior membership. Okay, redeposits of community property. This is where you are married or you're in a state registered domestic partnership while you're earning retirement credit with Acera. That retirement credit, when you divorce or dissolve that partnership, is considered community property, and that community property can be divided. Some of it can go to the ex-spouse. It all depends on how you negotiate it. Sometimes the Acera stuff doesn't get split off because you negotiate something else away, but often it does. So if part of that community property, part of your Acera credit goes to the ex-spouse, what they take is a portion of your service credit and a equivalent portion of your money of your employee contribution account. Okay, now they have a separate account. If they take a refund of their account, which they can do, we send you a letter in the mail telling you that they did that and giving you the opportunity to redeposit an equivalent amount of money, and then you can get an equivalent amount of service credit back, and that's called a redeposit of community property. And the last category of service credit purchase is other California prior public service. Okay. So what that is you used to work for another public agency in California. You were earning a pension system with whatever pension system they were using that wasn't Acera. There's a whole bunch of different pension systems in California. They're all separate. And you're not working there anymore. You're working here, and if you're not eligible to collect their pension, you can buy that time as a Sarah service credit. And there's usually two main reasons you're not eligible to collect their pension. One is that you didn't work there for long enough to be able to collect it. The second is that when you left that job, you took a refund from their pension system. Now, you do have to take the refund from that pension system to buy that time as a Sarah service credit, but you can buy all that time as a Sarah service credit. And there's a full list of what you can do with that at acera.org/service. One more thing I want to say about that is some people will ask, I used to work for another public agency. I have my pension credit on deposit, my money still on deposit with that agency. Should I take a refund from that agency to use to buy as a Sarah service credit? Well, there's a couple of main times when you do not want to do that. One is that you probably don't want to do that. I mean, you're going to have to run all the numbers and figure out all the rules yourself. We can walk you through it, um, and help you do it. But the two main reasons that you wouldn't want to do it probably are that you already earned enough credit over there to collect a pension from that system one day. You probably just want to leave your money there and go ahead and collect their pension when you become eligible because these purchases are way more expensive than the rest of these. Okay. The other California prior public service. The second main reason is if you establish reciprocity between the systems, then you cannot take a refund, and but you don't need to. You don't need to because you're already getting credit over there, and you will get to collect their pension one day if you retire from all the systems and start collecting your Sarah pension. You'll get to collect their pension as well. So those are the two main reasons you would not want to use this to buy a Sarah service credit. Okay, so let me before I get to the questions, I'm going to tell you um, how much the service credit purchase costs, when that you might want to, how to do it, how to figure out when, if you want to do it, how much it's going to cost, okay? And all that stuff, and how you can pay for it. First, let me tell you about time that is not eligible for purchase. Any time that you purchased additional vacation and you mark that on your timesheet, you did not earn service credit for it back, and you cannot purchase it back. Okay, any non-medical leave without pay, it's just some other type of leave without pay that's not for your medical condition, not purchasable. And like I said, any contract or temporary agency time before your Sarah covered position, not purchasable. Also, the other prior public service time, if you still have contributions on deposit with that other agency, you can't purchase the time as a Sarah service credit until you take a refund from that pension system. Okay, how much is it going to cost? It's going to cost whatever your employee contributions would have been had you worked the time. So, for example, let's say that you're trying to buy 3 months of unpaid medical leave. So, you return from the unpaid medical leave for your condition and you're trying to buy that 3 months. Well, had you been working here for that 3 months and receiving a paycheck, we would have been taking an Insera employee contribution out of your paycheck. So whatever that dollar amount would have been that you would have had to contribute during that 3 months, that's the dollar amount that it's going to take, that's going to cost for you to purchase that 3 months worth of time. Okay. Plus, perhaps there could be interest that you're going to have to pay also, depending on how long you wait. If you try to purchase the service immediately, there you probably won't have to pay any interest because there won't have been any interest periods that have passed. But had you worked here for that 3 months, we would have taken those contributions and invested them. And if that time was from a long time ago, it would have earned more and more interest. And so whatever, however much money that interest would have earned, you will have to pay. We have two interest periods per year. The first 6 months, the last 6 months. So every time June 30th and December 31st passes and you don't make the purchase, that's another period of interest that you're going to have to pay. So the best time to purchase service credit is as soon as you can, because the longer you wait, the more expensive it gets. And the way that you actually figure out how much it's going to cost, because we don't yet have a calculator on our website, we're trying to work on that for you to like make an initial ballpark calculation. I mean, you can kind of do it yourself. You look at your pay stubs and figure out how much you would have had to pay during that time that you were out. And then you can look at our website if you go to acertador/interest and see how much interest we've posted between then and now. So you can kind of figure it out if you like math. Otherwise, sorry, I should move ahead. Otherwise, what you should do is just complete our purchase request form at acertador/forms. You submit that to us. We'll do all the calculations for you. We'll send you a letter in the mail with the cost. And at that point, you decide if you want to make the service credit purchase and how much of the service credit purchase you want to make, because you don't have to purchase all of it. You could purchase a portion of it, and we'll lay out all those options for you. Except for the redeposits. Those are all or none. And then we'll give you all these purchase options. So you can write us a check for a lump sum amount on a post-tax basis, or you could roll over pre-tax money if you have pre-tax money in another retirement account, like a 401k or 403b, 457b, or IRA. We'll help you roll the money over to make the purchase. Or we can do payroll deductions on a post-tax basis. So we'll take it out of your paycheck over time, or any combination of the above. So once you get the letter, you work with us and we'll set up a plan for you to make the purchase once you decide to do it. Okay, now let me go back and check out the service credit questions that have popped up. One person says, what happens to your sick days? Well, if you go straight from active work into retirement with zero gap in there, we will convert your sick leave on a 2-to-1 basis to service credit up to a cap that's in your MOU. A lot of the caps, excuse me, are 125 days that's convertible, which would convert down to 62 and a half days of service credit. We do that automatically for you. I talk about that in the pre-retirement webinar, or you can read about that at acera.org/service. Somebody's asking, how can we figure out dates if it's a long time ago for the service credit purchase? Well, if it was a long time ago and you don't have access to your payroll records, which would be the primary way to do it, your pay stubs, what you should do is you just go ahead and complete the purchase request form and tell us about when you think the time was. We'll contact your former employer or your employer, and we'll pull those records. So we do that all the time, and that's part of the process. If we do have to do that, though, it can take some time. This whole process, it might take a couple of months to hear back from us because we do get a lot of these requests. So if you just submitted the form and you've been waiting a couple of months, we're probably about to send you the letter. Okay, let's see here. That's about the next topic. Okay. Okay, so somebody's asking. If you sell your I told you if you sell your vacation, your earned vacation back to your employer, you don't get service credit for it. You may get salary credit for it in the salary part of the formula if you're in tiers 1 or 2. I'll talk about that in just a second when I talk about salary, but you don't get service credit. Okay, somebody's asking about the unpaid medical leave. Okay, I already answered that question. Is there a deadline to claim any of the? Yeah, and I mentioned the deadline to make the service credit purchases is before you retire, but you want to purchase it as soon as you can, except for the military leave has a shorter cutoff for, there's a shorter deadline. And you can read about that at acera.org/service. If you want to contact one of my colleagues to help you through it, if you already have a username and password for your account on our website, you can email us through there. There's uh, a a secure messaging system, and that's how we do all of our email since this past October. That's how we're doing all email between members and staff just to keep things secure. If you want to call us, you can call us, and you can access that once you log into your account. If you want to call us, it's 510-628 3000, and we have a call center here, and their entire job is to answer your questions about your retirement. Somebody's asking about TAP. So with the tap, you can you didn't earn service credit while you had the tap time, but you can purchase it later. So you would want to go ahead and go through this process to submit the purchase request form to find out how much it's going to cost to purchase the tap time. We already talked about how we determine the cost. Somebody's asking about the unpaid medical leave. Is it authorized medical leave or unauthorized medical leave? I don't know the distinction between those two, so I would suggest contacting my colleagues about that. And the shortcut is acera.org/contact, and you can find both how to email us and how to call us. Sorry that I don't know the answer to that. Somebody asked how to purchase the 2 weeks. How you initiate the purchase for all of the purchases is you complete the purchase request form at acera.org/forms. Somebody says that they were told their tap time is no longer purchasable. I've never heard of that before. It's possible. I'm kind of a generalist. If my colleagues are telling you something that represents their better understanding of the law, then that they could it's possible that they know better than me. It and now that this is actually piquing a memory. We used to have this rule that we got rid of that you had a certain time limit within to purchase certain categories of these. We got rid of that rule. So if we told you that a long time ago, You should go ahead and contact us again and ask about that. So I recommend going to acera.org/contact and asking about that again, just to verify. Are the purchases tax deductible? So the ones that you make on a pre-tax basis are rollovers, so those are not going to reduce your tax liability, and all the other ones are post-tax, so those are not going to reduce your tax liability either. From what date does the interest begin to accrue? Well, we have two interest periods, so whenever the June 30th and the December 31st pass and you don't make the purchase, I believe that's the cutoff for owing interest. But I think there's a 6 month lag on that as well. So you would definitely want to check with my colleagues on that. So if the time you're trying to buy is in March, June 30th passes, and then you buy the time sometime in between June 30th and December 31st, I think my understanding is you will not have to pay interest on that because of the 6 month lag. Okay, let's see here. If an employee leaves in a SARA position, but years go by before an official retirement, what happens to the remaining sick leave that accrued that was not used? Okay, whenever you leave your job and you do not immediately retire, you just lose all your sick leave. It just disappears. That's your employer's rule. So I'm sorry that that's the case. And then, oh, and somebody was saying what they were telling you. Okay, this is important. They're saying that your HR person told you that the tap time was not purchasable. There are a lot of rumors that go through your colleagues about how a Sarah works, and it's kind of like a game of telephone, and they mean well. But whenever you have a question about how a Sarah works, contact us directly or get it directly off of our website, because there's a lot of misinformation about there, a lot of misinformation out there. When purchasing service credit for part-time hours worked before the Acera entry date, is interest added into the total amount we can purchase? Yes. So the interest for all categories is always added. So the longer you wait to purchase it, the more expensive it gets. So it's good that you attend this and you hear me say that because a lot of people don't know that. We try to educate everyone on that, but we can't reach everyone. And then the next question, and then I'll move on after this. Um, because we gotta keep things moving, is that for the unpaid medical leave, it's your understanding that the medical leave must be authorized. Okay, this is that authorized versus unauthorized medical leave question again. I do not know the answer to this question. I'm sorry. I've never heard of that. Um, I will see if I can send off an email to my colleagues during the break time and see if I can get that question answered. But otherwise, you should just go ahead and call them at 510-628-3000. Okay, so the last component, moving on to the highest average monthly salary. And the service credit is the longest discussion among these three. So we already talked about the age factor percentage, how we calculate that, how we calculate years of service credit. Let's move on to how we calculate highest average monthly salary. When you go to retire, our software finds your period of highest pay from anywhere in your career. It's called your final compensation period, and that's our pension lingo for it. If you're in tiers 1 and 3, it's your highest consecutive 26 biweekly or 12 monthly pay periods. If you're in tiers 2 and 4, it's your highest 78 biweekly or 36 monthly pay periods. So this is one of those times where there's a big difference between the tiers. Okay. So essentially, your period of highest pay, your final compensation period for tiers 1 and 3 is your highest consecutive year of pay from anywhere in your career. For tiers 2 and 4, it's your highest, essentially 3 years of consecutive pay from anywhere in your career. Okay. Now, because you're probably a new employee or you're in your middle of your career, your periods of highest pay are probably ahead of you because of cost of living increases, um, raises, perhaps promotions or switching jobs. So your periods of highest pay are probably ahead of you. But again, it's going to be your highest year in tiers 1 and 3 or your highest 3 years in tiers 2 and 4. And what we do is our software looks at your total pay during that highest year or highest 3 years. And our goal is to just take an average month per month. And so we divide it by the number of months in that period by 12 or 36. And that gives us the highest average monthly salary. So probably most of you are in tiers 2 and 4. So we look at your total pay for 3 years divided by 36 months to get an average. And that's what we plug into the retirement formula. Somebody asked about whether it's gross or net pay, it's gross pay before any deductions are taken out. And there are four types of gross pay that will go into this calculation that are paid during the final compensation period. Okay. The first, making up the bulk of your highest average salary, is your base pay. The second are some other pay codes you may have, sometimes known as footnotes. Now, I don't know which pay codes count for this and which do not, because there's like 1,000 different pay codes. So if you want to figure it out, if you're curious, you can visit our pay code page on our website. So you go to acera.org/paycodes, and there is a PDF there for your employer. You can find your pay code on there, and it'll say yes or no whether it counts toward this calculation or not. The one pay code I know that never counts is overtime, and my mouse just ran out of batteries, so let me grab my cord real fast. Okay, hang on for 1 second. Okay, sorry about that. Okay, now there's two more pay types that may or can be included in here. And these are based on compensation for your earned vacation that you're not going to take. This is only for tiers 1 and 2. So this is vacation that you sell back to your employer for cash, and vacation that you cash out when you stop working here, because that's just vacation that's left over on the books, and they will cash you out at that time. Okay, so that's again, that's only for tiers 1 and 2. Tier 3 is LERPD. They do not allow that. Tier 4, when the state created Tier 4, they disallowed that to the vacation compensation account for salary. So it's for tiers 1 and 2 only. Now, I do not take a deep dive into that topic because we can spend 10, 15, 20, 25 minutes talking about that. If you do want to hear more about that, you can either read about it at acera.org/vacation, or you can watch me talk about it in the pre-retirement webinar. If you go to acera.org, and you just go to the homepage, scroll down to the bottom. There are webinars and seminars here. I'm not sure why the mid-career isn't showing up. There we go. And you just click on the pre-retirement webinar. It's a YouTube video, and all you need to do is fast forward through the slides until you see basically the slide I was just showing you. And at that point, I do take a deep dive into that topic if you are curious about that. Okay. Um, so some of that, there's a cap on it, but some of that can be included as salary for the purposes of calculating your retirement. And then you can, if you click the YouTube thing here, you can it'll link you over to YouTube and you can watch it there. Okay, so that is how we calculate the highest average monthly salary. One more thing I want to say about this is that for all the tier 4 people, one of the state's rules, the law that they passed that created tier 4, is that there is a limit, a cap on the annual dollars that a Acera is allowed to consider for the purposes of calculating your highest average monthly salary. So if you have a salary that's higher and I'm showing you the 2026 caps here, if you have a salary as a general member that's higher than $159,733 per year, or 191,679 for safety members. Any annual dollars above that cap, Sarah is not allowed to consider for the purposes of calculating your highest average monthly salary. So your salary is limited by that. That again is the state's law. Now these numbers go up every year. It's based on the Social Security wage index limit, and you can always find what the limits are in any particular year at acera.org/limits. The way this works functionally for you while you're an active member is that let's say that you have a $200,000 salary. You'll probably hit the cap maybe in October. So whenever you hit the cap, our software will see that and it will stop taking out employee retirement contributions from your check for the rest of the calendar year. So between then and December 31st, you'll have more money show up in your check, and then you can use that to save in your personal savings or your 457B account, and then it picks back up on January 1st, and we start taking the contributions out again. Um, and then somebody asked about the limits for the cash out for the vacation sales. Yeah, like I said, I'm not gonna cover that in this, but definitely check out that info in the pre-retirement webinar. And somebody is asking for tier two, you count the highest 3 years of salary anytime in your career, not the last 3 years. Correct. So going back to that slide, this is the highest 3 years from anywhere in your career, not the last 3 years. Now, for the vast majority of people, it's going to be the last 3 years, but maybe not. Maybe not for you. Maybe you take a different job that pays a lesser rate at the end, or for some other reason you have a lower salary. Then your final compensation period would not be at the end of your career. And then there's a question: can this limit change for tier four in the future with any further changes to the law, or is it locked in for folks? I mean, regarding the vacation sales and cash out, I think my comments earlier apply to that where I'm not aware of any appetite at the state level for changing the law regarding pensions. And so, your guess is as good as mine about whether they would change that in the future. Okay, and let me show you this one thing before we take a little break. This is the whole thing put together, the retirement allowance formula example. This tier four member retires at age 65 after earning 25 years of service credit. Because they're a general tier four member and they're retiring at age 65, from the age factor percentage chart, we pull out 2.30%. They earned exactly 25 years of service credit, which is 25.00000. Their salary was $6,000, and when we multiply it all out, that equals a $3,450 monthly retirement allowance that we would pay them every month for the rest of their life. I want to point out a couple of things about this. One, the decimal places after the years of service credit. You get all the decimal places after your years of service credit. If you look in your account, it will say, if you've been here 7+ years, it will say 7.842625. All those decimal places are as calculating your service credit down to the fraction of a day, and you get all the decimal places in the calculation for you. So you earn service credit right up till your last 15 minutes on your last day of work in this job. The other thing I want to point out is if you take the age factor percentage and the years of service credit and multiply them together, like I showed you in the original example, you get 57.5% salary replacement. So that means that they are getting 2.30% of their highest salary for each of the 25 years of service. So when we multiply them out, they're replacing 57.5% of the $6,000 with their monthly retirement allowance, and 57.5% of 6,000 is 3,450. Okay, let's talk about the next um, topic here. Before I do that, though, I see a question that just popped up. If you need to retire right away due to having to be a caretaker for an ill family member, is that allowed, and how soon can you retire? As far as I know, in cases that are basically an emergency like that, you can retire as if you're already eligible. You have to be eligible, but you can retire as soon as tomorrow. Like if you have done any, put in any hours in today, you can't retire today, but I think you can submit a retirement application today and be retired tomorrow. So if you need to do that though, definitely call into our office and have them help you through that though, because I would want to make sure I'm not telling you the wrong thing. But I don't. I think that that's the right answer. Okay, let me help you get a precision pension estimate. Here's what you do. You go to acera.org. You click the login button. If you haven't created an account, you follow the instructions that I gave you earlier. Once you get in there and you use your username and password to get in there, you click estimate a benefit. I'm going to zoom in here so you can see it a little bit better. And these are just screenshots because it's more efficient to do it this way. So what you're going to do is you are going to type in, you're going to think of your plausible retirement scenario. Maybe you're retiring 10 years from now, 15 years from now, 20 years from now, and you're going to enter a set of dates that fit that scenario. So, what it's asking for regarding separation date is your last day on payroll with your employer. Payments begin date has to be at least the next day, and that would be your first day of retirement. Okay. Now, it's okay if there's a gap here, like if you're going to leave employment and defer your retirement to a later date, become what we call a deferred member. That's totally fine. You can do that. Scenario here, just put in the dates that match the benefit estimate scenario that you want to get an estimate for. You can put in beneficiary info here if you want. If it's pre-populated with your beneficiary that you currently have on file with us, make sure the date of birth is correct and click generate. You end up with this PDF retirement benefit estimate. And in here, in this box here, it gives you, oh, and this is page 2. This shows you the different info that it's using to calculate the estimate on page 1, including the salary projection, the average salary date range. So this is the final compensation period. So it is actually projecting a final compensation period for you, and then it's projecting a salary for you during that compensation period. Now, it's not increasing your salary, so it's using your last paycheck on file, and it's filling in any future pay periods with that number. So it's not going to increase your salary for you. And then it's projecting years of service credit in your scenario and your age at retirement. And then if you zoom in on the estimated monthly benefit on page 1, you see different retirement allowance options. You don't really need to understand these at this point in your career. This is something more that you probably may want to understand when you get closer to retirement because it gives different options for you to leave different amounts to a beneficiary. And your beneficiary situation might be different by the time you get to retirement. So I like to just tell people navigate by the unmodified option number, which most people pick anyway because it pays the highest amount of any of the options. And when the way that you pick your option is on your retirement application, so you don't do that until you're actually retiring and submitting an application. If you do want to know more about the options, though, we do explain them in detail at acera.org/options. And then let's see, somebody's asking if you defer payment, does it benefit in any way? Let me talk about that a little bit later. Okay. So that is how you get a precision retirement benefit estimate. And let me just say a couple more things about that. One is that you can make as many of these as you want. So make one for, every 6 months between 5 years from now and 25 years from now, if you want, just to see how it works, what the increase is to the dollar amount of your retirement allowance, your projected retirement allowance, should you work longer. So you can make as many of these as you want. You could do hundreds, and this tool is available 24/7. So use it as much as you want. We will revisit this when we talk about making a retirement planning picture. Let me help you understand retirement eligibility. When are you first eligible to retire? And it's this milestone right here. It's through some combination of your years of service credit and your age. If you're in tiers 1 and 3, there's 3 combinations that get you there, and I'll show you tier 4 in just a minute. Your first combination for tiers 1 and 3 is that you are at least age 50, you have at least 5 years of service credit, and you have at least 10 years of membership. Now, these three tiers closed more than 10 years ago, so everyone in those tiers has at least 10 years of membership. You can just ignore that number. So you're looking at age 50, you're at least age 50, you have at least 5 years of service credit, you can retire from a Sarah. So it doesn't take a lot it doesn't take a high age or a lot of service credit to retire from a Sarah. Option two, combination two, is that as a general member, you are at least 30, you have at least 30 years of service credit. As a safety member, you have at least 20 years of service credit and you can retire at any age, even if it's younger than age 50. Or at age 70, you can retire with any amount of service credit, even if it's less than the 5 years you need to retire under the first combination. Okay, so if you have 4 years of service credit, you could retire at age 70. Okay, then, okay, just real quick, somebody's asking if I married a year ago, how many years after marriage is the spouse um, eligible for spousal benefits? If you're talking about death benefits, as long as you designate them immediately, um, they will be eligible for your active member death benefits immediately. Let me talk about that when I get to the death benefits. Okay. So regarding retirement eligibility, for tier four, you have two combinations that get you there. You got your option one is you're at least age 52 as a general member. Option two is I'm sorry, and you're at least age 50 as a safety member, and you have at least 5 years of service credit. You can retire under option one for tier four. Option two is that you can have any amount of service credit, even if it's less than the 5 years you need under option number one, you can retire at age 70. So that would be a career planning option is if you leave with less than five, you could leave your contributions on deposit, and at age 70, you could draw a lifetime pension based on that less than 5 years of service credit. Okay, let me talk a little bit about some additional benefits that we offer, including healthcare benefits and death benefits. There's also disability retirement. I'll just touch on that briefly. If you ever become permanently disabled and you can no longer perform your job duties, you can apply for disability retirement from a SARA. It's kind of a separate type of retirement from the regular retirement that we call service retirement. There's a lot of info about that on our website at acera.org/disability if you want to check that out. Okay, so let's talk about healthcare and death benefits. I only want to tell you about the healthcare benefits very quickly because um, they might, they might look a little bit different by the time you all get there. Who knows? Who knows what's going to happen in this country? This is what they are now. But there are some career planning implications for the way that the healthcare benefits work currently that I just want to tell you about. Okay. So when you go to retire from a SARA, we offer to SARA retirees the ability to enroll in medical, dental, vision plans, and we offer subsidies if you qualify to help you pay for the cost of being in those plans. There are five non-guaranteed benefits here. So these are not vested. These are not uh, guaranteed benefits. And they're not guaranteed because they're extra benefits that we offer because we run this reserve fund that the county started in the 80s. And our Board of Retirement runs this fund. It has over $1.2 billion in it so that we can pay you these extra benefits if you qualify for them in retirement. So you can pay for the things that you need, like medical, dental, and vision coverage. This is paid on top of your SARA pension because your pension is guaranteed. So that's separate. These are non-guaranteed extra benefits. Now, because the Board of Retirement manages this fund, they may tweak these rules from time to time. So I just want to notify you about that. And they do that to ensure the fund stays sustainable into the future so that they can continue to offer the healthcare and other benefits on the list. So the benefits are the medical subsidy, which is called the monthly medical allowance, which is what MMA stands for. And there's three levels of it. There's a dental and vision subsidy, there's a Medicare subsidy, and a supplemental extra cost of living adjustment on top of the vested one. Now, the reason I'm telling you about this as a new employer, mid-career employee, is because you need a certain number of Acera service credit, a certain amount of years of Acera service credit to qualify for this. Reciprocal service credit doesn't count, okay? So this could figure into your career planning because the minimum years of service credit that you need to access the healthcare subsidies is 10 years. And then if you hit the 15 and 20 year mark, you get more of a medical subsidy. So that's basically the reason I'm telling you this now is because you may want to target at least hitting the 10 years, if not the 15 and 20 year mark. Um, so let's say that you've been working here for 9.5 years so far and you're thinking about doing something else. Well, you may want to stick it out another 6 months, get over the 10-year mark, because this medical, dental, and vision and Medicare subsidy represents a lot of additional money on top of your pension, your guaranteed pension, that will help you pay for your life in retirement. So, what I like to do is bring out the pension milestone chart here and add this minimum healthcare subsidy milestone of 10 years. So, it's definitely something to consider when doing your career planning. And somebody's asking, are the medical benefits the same for all employers that participate in ACERA? They are. So once you leave your employer, then we offered the same medical benefits to every all the ACERA members, regardless of what employer you came from. And if you want to read more details about the current benefits, we do have a healthcare page out on the website which is under retirees, healthcare plans, and benefits. And we go through all of it. And we even have a 36-page enrollment guide that has all the details. Okay, the last benefit that I want to talk about regarding other benefits is the death benefits and designating your beneficiary or beneficiaries for those death benefits. Okay. Um, so, and keeping them current. Okay. So, who is your beneficiary? Well, who is a beneficiary? That's just somebody who gets a benefit. Your ACERA beneficiary is the person that you designate to get your ACERA death benefits. Okay. Now, so let me walk you through what the death benefits are that would be available to your beneficiaries should you die before retirement. The death benefits available to your beneficiaries if you die after retirement is a little bit different. We go through that in the pre-retirement webinar. So if you're curious about that, you can either uh, watch that webinar or you can go to acera.org/death, and that is where we talk about all the death benefits for all situations. So these are death benefits available to your beneficiaries should you die before retirement. If you are currently working for one of our employers, but you are not yet vested, and you die during that time, and I'm not saying that you die at work, you just die while you're, in active status with your employer. We would provide your beneficiary, who you've designated with a SARA, basically a refund of your employee contribution account, including the interest. And we would also give them 1 month of salary for each year of service that you've worked, with a cap of 6 months worth. So if you had worked here for 4 years already, they would get you 4 months of your salary. Okay, so that's if you're not yet vested. Now, if you're vested, if you've already achieved 5 years of service credit, your beneficiaries get a choice. They still get that same option that I just mentioned, option one, but they could also get a monthly survivor's allowance, and this is to spouse, domestic partner, or minor children only. Those are the qualified beneficiaries. Or option three, which is a blend of a lump sum one-time payment and a reduced survivor's allowance. But now that I mentioned that it's qualified beneficiaries only, there's a way that you can expand the group of people that you can name for a lifetime survivor's allowance by making the advanced death benefit election. All active members should make this advanced death benefit election. There's no downside. What it does is it guarantees, if you have made this election, that your beneficiaries will receive whatever the maximum benefits are. If you don't do it, they're not necessarily going to get the maximum benefits, and you can only leave a monthly survivor's allowance to spouse, domestic partner, minor children. If you make the advanced death benefit election, your survivor who you have named for a lifetime survivor's allowance can be anyone. It doesn't have to be one of those people. Okay. And the way that you make the advanced death benefit election is very easy. You can read more info at acera.org/ADV if you want. But all you need to do is fill out our beneficiary designation form. Now, we informed everyone about this maybe like a year and a half to 2 years ago that we introduced this new thing. If you redesignated your beneficiary during that time and you checked that box, you're golden. If you didn't, or you don't remember whether you did, or you're brand new, you can at this point redesignate your beneficiary and check the box. Now, if you don't remember whether you did it, there's nothing in your account on our website that tells you whether you did it. We haven't figured that out yet, but you can contact us and we can let you know whether you did it or not. Or you can just be safe and fill out the beneficiary designation form again. Now, if you're brand new, you also have the option of doing this on the Acera welcome form. And if you're within your first 7 weeks, just wait for the Acera welcome letter and it will give you a link to the Acera welcome form, at which point you can make the advanced death benefit election and designate your beneficiaries. But if you did already did that, you're golden. If you don't know whether you did that, you can always redesignate your beneficiary anytime, and that is just the case in all cases. You can keep your beneficiary up to date by just filling out the form again. If you designated a beneficiary for some other benefit with your employer, like um, disability insurance or death benefits with your employer, that does not count here. You have to designate your beneficiary with Acera on our forms to make this happen. So let me walk you through this. All you do is you save the form to your device, complete all the fields, check the box, print and sign the form, and then there's instructions on how to submit it. So let me go over there and I'll just walk you through it. You go to acera.org/BEN. That's the shortcut. It's a PDF. Your first step, click the download button, download it to your device because once you fill it out, it's electronically fillable. You can save it for the future, and so you don't. If you want to resubmit it, you don't have to fill it all out again. Okay, so you fill out your information, you name your beneficiaries, um, you name contingent beneficiaries. That's always good to do in case you haven't redesignated your beneficiaries, and when you die, your primary beneficiaries have already predeceased you. And then when you get down to section 4, you just check the box. Okay, there's no disadvantage to doing this. And then you follow the rest of the instructions on the last page. There's 5 different options for submitting the form. You do have to print and sign this one, but there are 5 options for to send it to us, including electronic options, and you can upload it to your account on our website. So every active member should do this. Okay, so continuing with this topic, death benefits before retirement. Let's say that you have moved on from your position and you no longer work for one of our 6 employers. Somebody's asking, is there a list of employers? Yes, there is. If you visit acera.org, go under employers right here, participating employers. There's the list of the 6 right there. So if you no longer work for one of those 6, but you're still an Acera member, you're a deferred member, the death benefits would simply be a return of the balance of your contribution account to your beneficiary. Definitely good to keep your beneficiaries current. You can always check them in your account on our website. There is a beneficiary area where you can read who your beneficiaries are. If you get in there and your beneficiaries are out of date, like it's your spouse from 3 spouses ago, you're going to want to go ahead and redesignate your beneficiary. You can do it as much as you want, just at acera.org/BEN. Okay, so we have about 30 minutes left before I pass it on to the 457B expert, so that's exactly enough time to go through the career planning options and make a retirement planning picture. So let's jump right in here. And any questions that are still lingering on the board that I haven't got to, whenever the 457B expert takes over, Gene Hilliard, I'll try to type all those out for you. So sorry I haven't been able to get to those yet. Okay, understanding career planning options. What I mean by this is that at some point, you're going to stop working for your Acera covered employer. What are your options? You kind of have 2 main options, so I'm going to number those 1 and 2. Your first is to retire from Acera, and your second is going to be to not retire immediately from Acera. And then under that second option, you're going to have 3 sub options, A, B, and C. Okay, so let's talk about your first option, retire. So if you leave your job for one of our six employers and you're eligible to retire, you can just go ahead and retire and start drawing the lifetime pension. You earn service credit right up until the last 15 minutes on your last day of work. We'll convert your sick leave to service credit on a 2-to-1 basis up to a cap. So you'll get a little sick service credit boost. You can even go back to work after you retire for anywhere that you want, and we don't care. We are going to consider you an Acera retiree if you work somewhere else. However, if you do come back to work for one of our six employers, you do have two options. You can continue your retirement payments from Acera, in which case you're not going to earn a second retirement, additional credit toward retirement, and there are some heavy restrictions on that you can read at acera.org/working. Your second option, if you do come back to work for one of our employers, is that you can pause your retirement payments. This is brand new in the last couple of years. If you pause your retirement payments, you do earn a second retirement. You earn more credit toward retirement. And at the second retirement, we'll restart the first retirement and then we'll add to it the second retirement. So you'll get a much higher payment because of the second retirement that you earned. And and like I said, that's brand new. And so what it means is that when you stop working here and you decide to immediately retire, if you do decide to come back to work for your employer or one of our six employers, you do have a lot of options here, and you can just come back to work and pause your retirement payments from Acera. So it's like your retirement isn't necessarily permanent anymore. Okay. Option two is not retiring immediately. This is you stop working for one of our employers, but you don't retire yet. So, like I said, you have three sub options, A, B, and C. Option A is going to be become a deferred member. Option B is to establish reciprocity. Option C is going to take a refund. So let me walk you through each one of those. If you become a deferred member, what happens is that your termination date and your possible future retirement date will now not be consecutive days. They will have a gap here, okay? And as a deferred member, you are still an Acera member because you still have contributions on deposit with us. Um, your membership just kind of goes on hold. You don't earn any more service credit toward retirement, but you also don't pay anything more into the retirement system. Interest continues to accumulate every time the fund earns interest. And people ask what I mean by no negative interest. We never take money out of your account. If we have a 6-month investment period where we, on paper, have a negative return, we don't pass that negative return onto your account. We only pass positive returns onto your account. And there's nowhere that I have ever seen that earns the type of interest that Acera has historically earned, that there is zero risk. We never take money out of your account. If you are curious about how much interest that we have earned historically, you can visit acera.org/interest. That's a shortcut. Just because we earned that amount of interest in the past, of course, the fine print is that it doesn't guarantee that we're going to earn that interest in the future. But that's just something that is good to keep in mind. Okay, as a deferred member, you can retire later out of deferred status. So you can stop working and then you can retire later. Okay. Or you could come back to work and earn more credit toward retirement. So you do have that option. You can come back to work for one of our employers, or you could be refunded at any time. Okay. So when you stop working here, you don't have to make an immediate decision if you're going to take option C, whether you're going to take a refund or not. You can make that decision later because you can retire later or you can take a refund later. So you have time to do that. And while you're thinking about it, interest is going to continue to accumulate whenever the fund earns interest. There's more on that at acera.org/defer. There are some good reasons on there to become a deferred member. Usually it's because you're done working here, but you're not eligible to retire yet. There are some not so good reasons to become a deferred member, and that webpage will walk you through it. One of them it'll tell you about is if you're already eligible to retire and you don't retire immediately because you're waiting for your age factor percentage to go up. Whenever I do that math, I mean, you can do it for yourself, but yes, when you retire later, you will have a higher payment, but you're missing out on lots of monthly payments. And whenever I've sat down to do the math, you never catch up. So I don't think that's a good reason to become a deferred member if you're already eligible, especially since you can come back to work for Acera if you change your mind and earn a second retirement. Okay, so that's option A, become a deferred member. Option B is that you establish reciprocity, with another retirement system in California, another pension plan in California. We have reciprocity with many California cities, with all the counties in California that have their own pension system, with the state of California and state jobs, because they use a system called CalPERS, or any agency that uses CalPERS. Sometimes they're small agencies, they're not big enough to run their own pension system, so they'll use CalPERS. We have reciprocity with all of those. There's a full list at acera.org/reciprocity. And when you establish reciprocity, what's happening is you're linking the retirement systems together to get synergistic effects of linking them together. So those synergistic effects, the benefits are one, that the service credit that you earn in all the systems combined is considered when we're looking at whether you're vested or eligible to retire. If you have 2 years in Contra Costa County and 3 years at Acera and you've linked them together, that's 5 years combined. If you're at least age 52 as a general tier 4 member, you're eligible to retire. Whereas if you hadn't linked them together, you'd have 2 in one and 3 in the other. You wouldn't be able to retire from either. The second synergistic effect is that the highest average salary that you earn under any reciprocal system is used by all of the systems in the salary component of their retirement formula. So, for example, you were working over in Contra Costa County and making $20 an hour. Now you're working for an Acera employer making $35 an hour. And let's say you work for 2 years over there and 10 years over here. Okay. You link the systems together. When you go to retire, you retire from both systems at the same time on the same day. We're both going to do a calculation, and we are both going to use the higher salary that you earned under either of those systems, which, as we know now in the example, is at in Acera. So your previous system is going to use the higher salary. So you're going to get a much higher pension from that earlier system than you would have had they been using the $20 an hour figure that you were making over there. So this actually is one of the ways that you can dial in your total retirement allowance, your pension, is by switching systems. I don't, it's part of the law. And if you do find a higher paying job in a different system, and this system that your employer wasn't able to, find a higher paying promotion for you, you could, I mean, that is a way to do it. You can switch systems, get a higher salary, and all the systems linked together will use a higher salary when they calculate your retirement. The other two benefits is that it could lower your contribution rate. Because it might put you in an earlier tier, and it could put you in that earlier tier, in which case you might have the benefit of a more favorable set of age factor percentages. And what you're doing when you establish reciprocity is you are deferring, you're becoming a deferred member in all of the systems that you're linking together. So you need to leave your contributions on deposit with all the systems. And there can be no more than a 6 month gap when you leave one system. You terminate one job and start the next job. Okay. No more than a 6 month gap. And you can't have more than 12 weeks of overlapping service. I always suggest people have 0 weeks, and that makes it nice and clean. You stop one job, they'll cash you out for your vacation anyway. And then you start the next job on in the next week. Some people will try to be on vacation in one job while they're starting the next job. I just recommend not doing that, and that will keep the reciprocity nice and clean, and you got to retire from all the systems on the same day. And then somebody's asking if I'm a deferred member, do I need to be a full-time employee to re-enter Acera? I don't think so. I would definitely check with my colleagues on that, call in about that. But I think once you leave, you become a deferred member, and then you get a new position with one of our employers. My guess is that you would, even if it's part time, you would pick back up and you would start earning more credit toward retirement. Even, it's at a slower rate that you would be earning service credit, but I don't think you would have to come back full time. Definitely call in and check with my colleagues on that, though, just to make sure I'm not misguiding you. And somebody's saying, do you get two retirement checks with reciprocity? Yes, you get one check from each system that you have linked together. So we're all separate. The only thing that the only information that we're sharing is that you're retiring from all the systems on the same day, that you how much service credit you've earned under each system to make sure that the combined is allows you to retire in the salary component. Otherwise, we're all separate. We're all doing our separate calculations. Okay, so that's options A and B. Option C is that if you stop working here and you don't retire yet, you can take a refund of your contribution account and all the interest that we posted to it. If you take a lump sum payment and you're not rolling it over into a pre-tax retirement account, you may lose a third of your money to taxes and penalties, especially if you're younger than 59 and a half, because that's when the penalties come in. If you don't want to lose any of your money, you can roll it all over into another pre-tax retirement account. We will help you do that. Refunds take time, maybe 2 months or more to process. And when you do that, you're waiving all your rights to ACERA benefits. You're saying, don't give me the lifetime pension. I don't want access to the healthcare benefits or the ability to enroll in the healthcare plans or access to the death benefits. I just want to take my money and go do something else with it. And that is absolutely your right. You do have a right to take a refund if you want. Just remember that I said that if you do instead defer, um, where was that? This one, defer. If you do instead defer and then retire later and take the lifetime pension, like if you, whenever you leave, you will become eligible to retire or you are eligible to retire, we're already going to refund all of your money within your first 3 to 5 years. It's just in the form of a monthly payment. We're going to give it to you all to you back. So in most cases, if you are eligible to retire or you will be eligible to retire, taking a refund, you make way less money over your lifetime than you would if you take the lifetime pension. You don't have to take my word for it though. You can do the math yourself and figure that out. Okay. So now we have just enough time. We have about 18 minutes to make a retirement planning picture. Okay. So this is where we are taking a little peek into the future and we are spending a little time now to look into the future to see what your income will look like in the future in the form of your ACERA pension or other pensions, your Social Security income. And then we are going to figure out if between those two sources of income alone, you are pointed in the trajectory of replacing 80% of your working salary with retirement income. And if not, how much additional you might want to save now to get started, making sure that you have enough in this savings category so that when you get to retirement, you will have achieved 80% income replacement. And we're not going to do any math. We're going to use all online calculators. Okay, so it's actually super easy. Let me walk you through it. Okay, your first step is to get some estimates. You get your Sarah estimate, and you can when you sit down to do this, you can get out scratch paper just to record the estimates, or all of the estimators generate a PDF, so you can just save those on your device wherever you want. Okay. Now, what I'm gonna do, I'm gonna walk you through a scenario where I'm gonna get a projection for retiring at age 62, and I recommend starting there. So get a projection for retiring from a Sarah at age 62 and collecting Social Security at age 62. I like to use that as a baseline because whenever you do that, and as soon as you retire, you're collecting Social Security, so you get to count it as retirement income right off the bat. And it gets to contribute to whether you're achieving your salary replacement or not. Now, once you run through the calculator the first time using age 62, then I recommend if you want to try retiring earlier, you can see what happens if you change all the numbers so that you're retiring at 61 or 60 or 59 or 58. And in that case, you wouldn't be collecting Social Security right off the bat. So maybe you've saved enough, maybe you've dialed your savings up enough to allow you to retire earlier. Okay. So I'm going to do age 62 scenario. So all you do, like I showed you before, is you go to acera.org, you log into your account. You use the benefit estimator. You think of your plausible retirement scenario where you're retiring at age 62 to start off with. You hit generate. You end up with your PDF retirement benefit estimate. You look at the unmodified number. Okay, that's your Acera estimate for age 62. Okay, and when you're typing in your dates, you're doing a scenario where the dates match you retiring at age 62. Then you go out to Social Security and you get an estimate from them at ssa.gov/estimator. It actually looks a little bit different from this now. I haven't updated the screenshot, but they'll do kind of the same thing. They'll give you three dates, three ages. They'll show you an estimate for age 62. They'll show you one for maybe 65 or 66 or 67, and then age 70. So initially, you're going to look at the age 62 one, but there's a slider in there that you'll see that you can pick any age after 62. So you can refine that. Okay. But like I said, I'm going to stick with the age 62 scenario. Okay. So in this scenario where this person is retiring at age 62, they're going to get a $3,007 month per month pension from Acera, and they're going to get $2,046 per month from Social Security. Okay, so what we don't know at this point is whether that dollar amount is going to be 80% of our income. Like those are just, dollars that we have. Like it's kind of meaningless at this point until we plug those numbers into a retirement calculator. So there are various retirement calculators that are free to use online. Usually they're posted there and created by different investment companies, and what they want to do is they want you to use their calculator to figure out how much you need to save, and then they want you to invest with them. Well, you don't have to do that. You can just use their calculator for free. And so here are some examples. The best ones allow you to put in a pension amount and a Social Security amount, and I think all of these do. And I'm going to walk you through the Vanguard calculator. If you do start a 457B account with your employer, I think most of them are run by Empower. And when you log into Empower, there's a similar calculator in there that you can use. And I recommend trying a few different ones because they'll all give you a different number. And you can kind of average them out, just to make sure that that the one that you're using isn't an outlier. Okay. So this is what the Vanguard calculator looks like, but let me just walk you through it live so that you can see how it goes. Okay, so here's how this works. We've already gotten a Acera estimate and a Social Security estimate. So if you go to acera.org/planning, or you go to acera.org and you go under members, there's this article right here, Planning Your Future Retirement Income. Now, this is kind of a longer version of what I'm kind of doing quickly with you right now. And we just actually launched this video a few months ago that walks you through it step by step, slowly. So you can revisit this concept by going to this video and just walking through it step by step. Okay. So all the links are in this on this page, and it has all the steps. So I'm going to scroll down. We've already gotten the Acera estimate, so we did that. We've already gotten the Social Security estimate. Okay, so then here are some links to the free calculators. Okay, so I'm just going to try out the Vanguard calculator. And what I'm going to do is plug in my retirement scenario where I'm going to retire at age 62. So you plug in whatever the numbers apply to you. Okay. Um, so let's say that we're going to retire at age 62, and let's say that this person is currently 35. And let's say that their salary is 85,000 per year. Okay. So what this is asking is how much of your income you currently save for retirement. And it's not asking about your Social Security or pension, it's asking additional savings. Now, if you don't save any additional for retirement, don't worry, because we're figuring out right now whether you need to save additional and how much you might want to save additional. So you could just leave this at zero if you don't save anything currently. Okay, and then it's asking you how much you've already saved. Like, what's the balance of your savings that you've already saved? Well, you don't have to, if you've saved nothing so far, don't worry about it. Just put in zero. This one is asking which what amount of income replacement you are targeting. Okay. I recommend starting with 80 because that's kind of the guideline that financial planners will tell you about. Um, sorry. They'll say you need 80% to maintain your 80% of your income, your pre-retirement income to maintain your standard of living. That's kind of the baseline, so I wouldn't probably try to go below that. But I recommend once you do this one time and you do 80, see what happens when you crank it up to 85, 90, 95, 100. Our 457B expert, Gene Hilliard, is going to try to get you pointed at 100% income replacement. Okay. So 80 is kind of the minimum that you might want to put in there, but play with the numbers. Okay. This one right here. This is kind of a loose thing. This what the assumption here is that if we do the calculator and we find that you do need to save additional to get pointed at 80% income replacement, the assumption is that you are going to invest your money somewhere with the potential of earning a certain amount of interest. Now, what people say is that the places that you might park your money, that invest your money, the higher um, the possibility of the possible potential interest that you might earn carries a higher financial risk. So that's just something to keep in mind. What this is basically asking is your appetite for short-term risk. Now, if you put your money in something that's very diverse, like the 457B plan, and you leave it in there over long periods of time, history has shown us that the markets tend to go up over long periods of time. So even though there are, ups and downs in the short term, over the long term, it goes up over long periods of time, and you tend to earn, if you annualize it, you earn a certain percentage. So I recommend putting somewhere between maybe 2% if you're super risk averse, or maybe 8%. I think maybe like 4% is pretty conservative because you can actually find high interest savings accounts with zero risk these days at 4% currently. Um, but Sarah, our fund, we assume we're going to earn 7%. We're kind of moderately conservative, so I'm going to leave it at kind of I'm gonna dial it back a little bit and go kind of moderately conservative at 6%. But I recommend somewhere between 4 and 7 or 8. Um, and you can read more about that if you read about historical interest rates, from like index funds or like the S&P 500, you can kind of get a sense of where to what number to put in here. I'm going to put in 6%. Okay, so I'm assuming I'm going to earn less money with my savings than Sarah assumes we're going to earn at 7%. Now, this is what makes this calculator really good is that you can put in the Social Security estimate, which I believe was $2,046 per month from paid from Social Security in retirement, and $3,007 from a Sarah paid in retirement. And then you hit calculate. And what it gives you is this graph where the gray side represents the amount of money it thinks you'll need to pay for your expenses in retirement based on the uh, data that you inputted into the calculator. Over here, it's telling you how much of your expenses you're going to be able to pay for based on your pension, which is the lighter green, and the Social Security, which is the little bit darker green. So that represents those two sources of income. And the goal here is to get them even because this is telling me that there's a gap here. I'm not going to have enough money to pay for my life in retirement from the pension and Social Security alone. Okay, so this is telling me I do need to save additional money because my expenses are projected to be this, but my income is projected to be this. So I need a third source of income in this scenario. So what I'm going to do to figure out how much, now that I've figured out that I do need to save additional money, is I'm going to edit the results and I'm going to add some annual retirement savings. So I'm going to say, what happens if I save $1,000 per year toward retirement, which would represent about 1.2% of my annual income? And I'm going to recalculate it. Now you see it has added a dark green bar here. So the total income has increased, but it hasn't quite gotten up to what we need yet. So we need to save more. So let's see what happens if I crank that all the way up to $6,000 per year, which is 7.1% of my income. I'm going to hit recalculate. Okay, so I kind of overshot it a little bit. Now you could leave it there if you want to have a buffer, but I want to see what happens if I try to get it even. So what happens if I pick $4,500, which would represent about 5.3% of my income? Okay, now you can see that they're kind of even. So I kind of hit it right on the nose there. So what this is telling me is in order to maintain my standard of living, in retirement, assuming that I'm only going to need 80% to replace, I'm only going to need to replace 80% of my working income with retirement income. Between my pension and my Social Security income and my additional savings, I will have enough to pay for my life. Okay, so that's the number. So it's telling you this is the number, 4,500 per year. Okay. That might sound like a lot to save, but what I recommend doing is splitting it up over pay periods to see how much that would equal out per your 26 pay periods. And so what that means is that you will have to save an additional $173 per pay period. That sounds a little more manageable. What you'll find though, if you decide that you want to save this additional money in your 457B account and take it directly out of your paycheck on a tax deferred basis, is you will not see a dollar for dollar decrease. So if you save $173 from your paycheck, your take home pay, because it's tax deferred, there will be maybe like a 25 to 30% decrease on this. So let's pick 25. So we'll multiply this amount by 0.75. Oops. And you would only see actually about $130 come out of your take home pay. So then you sit down and you think about, okay, can I take a $130 hit or whatever it is that comes out of the calculator? Can I find that amount in my paycheck? Maybe the answer is yes, maybe the answer is no, because you have a lot of bills, you have a life, you got a lot of stuff to pay for. What I recommend is that you just get started. Maybe you can do 20. If it's telling you 130, maybe you can start saving 20, which is the minimum that you would need to save from the in if you decide to save it in the 457B plan. So you get pointed in a direction of savings if it's telling you you need to save more. And then maybe you come back. Once you get used to that, you say, okay, maybe I can crank that up another $20. I can save $40 out of each paycheck. And then you crank it up another 20. I can save 60. And just try to keep cranking it and getting used to it over time until you hit the number that the calculator is telling you. Okay. And then you're pointed at your projected income replacement target. And then what I recommend is you come back over time, periodically, every 6 months, every year, and do all the calculators again. Do the Acera calculator, the Social Security one, plug it all into one of the calculators. Make sure that your amount of savings is still pointed in your target trajectory. Or maybe at that point you decide that you want to crank it up from 80 to 85% income replacement or 90% income replacement because you're getting really used to saving additional money. And so you just readjust it over time. And these are not exact. This is not an exact science. Markets go up and down, projections go up and down. They change the calculators. But I think what you'll find is if you revisit this periodically over time, and you can see that, I'm explaining it. It's taken me probably 15 minutes to explain it. You could probably go through the whole thing in 15, 20 minutes, just about every year. And if you come back and you keep doing it, I think you'll find that by the time you get to retirement, you will have achieved the income replacement percentage that you are looking for, that you are targeting. Okay. So now that we have determined, and if you go through this exercise, if you do determine that you do need to save an additional money and you have determined how much, then the final question is, where do I save the money? So if you're doing the calculator where you're assuming a certain interest rate, This one we were assuming 6%. You're going to want to try to put it somewhere, where it's, a diverse, a diverse portfolio that is fairly risk balanced. Something like the 457B plan, somewhere that you can actually earn inflation because I'm sorry, that you can actually earn interest because if you earn a significant amount of interest, it helps you do two things. It helps you beat inflation and it helps you earn more and more over the years through the power of compound interest. So if you look at a compound interest graph, it accelerates the longer you leave your money invested because you earn interest and then you earn interest on that interest and then you earn interest on that interest on that interest over long periods of time. Okay, but like I said, be cautious. Do research on where to park your money. Don't park it anywhere weird. I think like NerdWallet and Investopedia are great places to get very well explained, simply explained explanations of different places that you can put your money, the different concepts of where to invest. I happen to think that one of the best places you can park it, that you can put your money in and invest it, is in the 457B plan because it'll come right out of your paycheck. You don't have to think about it every time, and you have options to invest on a tax deferred basis, so it will lower your tax liability. Um, so you pay less income taxes now. And our 457B expert is going to walk you through all that. But there are some low risk options on the slide. All those are on the article, acera.org/planning. Okay, so that kind of exhausts my knowledge of the retirement planning process. So I hope you found that useful. So again, we have the Acera pension, we have the Social Security income, and then separate from that is your personal savings. So the 457B plan is separate from Acera. We don't run it, we don't have anything to do with it, but it is a type of retirement account that you all have access to as government employees. It's kind of like a 401k, but for government employees. And we just happen to have one of the foremost experts on these plans with us. Are you there, Gene?
I am here. How's it going, Mike?
Doing really well. Thanks for joining us.
Absolutely.
So,
Absolutely.
go ahead and share your screen, and I'll introduce you while you're working on that.
Okay.
Okay, so Gene Hilliard has been hired by Alameda County for many years now to provide this financial education on the 457B plan so that you all understand the nuts and bolts of how it works, so that you actually have a good place to save that additional amount toward retirement. Um, so even if you don't work for Alameda County, if you work for one of our other five employers, 99% of what Gene is going to tell you still applies to you. If you do work for Alameda County, you can meet with him for free if you start a 457B account, and he can advise you on your account and investments in general. Um, so, with that, take it away, Gene.
All right. Perfect. I'm
And
having some time.
your slides disappeared.
It did. Yep. Yeah. Let me give me a moment here. I will get this all straightened out. Let's
And
see.
somebody's asking, what's deferred comp? It's called deferred compensation because you're deferring a piece of your pay now for later. And so they take it out of your check. You can do it before taxes or after taxes. There's options for that. But that's why it's called deferred comp. And as a government employee, the deferred compensation system uses the 457B account to provide that deferred compensation mechanism for you all.
Perfect.
Okay,
Perfect
take it away, Gene.
explanation. All right. Well, good after or good morning, everyone. Again, my name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. And as Mike had mentioned, we were hired by the county, hired by Empower to provide retirement planning, investment advice, and education to county employees. I'm a 23-year vet of the financial services industry, in particular the stock market, and I'm also a retirement counselor. And my goal as a retirement counselor is to help each one of you maintain your current lifestyle in retirement. Okay, what does that mean? Well, the exact same paycheck that you're getting today or around the time you retire, I want to work with you to help you get the exact same paycheck, right? But that's going to be a challenge. But the good news, you work for Alameda County, great government agency, has one of the last Mohicans in terms of offering a pension. So many of you are going to be halfway there. So if you take half your salary that you're going to get from your pension, you factor in Social Security, you may have a shortfall of a few, maybe 20%, maybe 10%. And you can use deferred comp to plug that hole. So I'm going to talk a little bit about deferred comp, and it's actually called a 457B. And I'm just going to spend some time talking about the benefits. What is it? How do you invest your money? How do you spend the money once you leave county service? And then lastly, there's some updates to the plans that I want to make sure that you guys are all aware of. Okay, so here are the key topics. We'll talk a little bit about retirement income, benefits of saving, the updates, and how to enroll. Okay, so let's talk about your retirement income, right? You're pursuing the future you imagine, right? So if your goal is to save towards a comfortable retirement, it's important to understand how much money you're going to need. What exactly are you going to be doing in retirement? Are you traveling? If you're traveling, how often are you going to be traveling? Where are you going? How much is that going to cost you? Are you going to spend more time with your family, right? How much is that going to cost you? Do they live on the East Coast, West Coast, out of the country? How often are you going to go see them? How much is that going to cost, et cetera, et cetera? So you want to kind of attempt to determine exactly how much money you're going to need in retirement. So this is kind of your fun stuff. And then you want to also make sure you have enough to cover your bills. And I'm going to talk a little bit about that as well. But I'd like to, for a moment, shift gears because I have found when people talk about or think about retirement, they think about it in terms of age. I'm going to be 67 when I retire or 70 when I retire, right? But there are quite a few folks, and maybe some of you on the phone, who would like to semi-retire or, just stop working for a little while. Maybe you want to discontinue working at age 60 or at age 55, age 50, maybe 60. Maybe you don't want to wait that long. And there's ways in which you can make that happen using your deferred comp, right? So just think about if you were able to have more control over your time, right? Right now, you don't have control over your time, especially Monday through Friday. You got to go to work. But wouldn't it be nice if you had control of your time so you can kind of focus on doing some of the things that are more important to you? For example, maybe you want to spend more time with your grandkids, right? Uh, Not only that, maybe there was a business you wanted to start and you just never had enough time to really make that happen. Or maybe there's a community service project, an organization that you feel strongly about, and you just don't have the time to make that happen, right? So maybe you want to create a strategy so you can potentially create that time, right? Maybe retire, leave county service at 55, right? Now, granted, we all know your ACERA, or you will know your ACERA is tied to your years of service, your age, and your average salary, right? So if you retire at a 55, your percent of your salary that you're going to get for the rest of your life probably is going to be pretty small, maybe 25, 30%. But right? But think about it like this. If I can get 30% of my salary from ACERA, maybe I can work part-time doing something maybe I enjoy, right? Or maybe it's at night, or et cetera, to maybe come up with the other 30%. So now you're at 60. Now, typically retirees need, or when you're thinking about semi-retiring, you're going to need about 80%. So if you're getting 30% hypothetically from ACERA, you're getting 30% from a part-time job, you're short 20%. Come to me and I can say, this is how much you need to save to get to that 20%. And maybe you can retire at 55. So I just want to let you folks on the call know this. this type of program is not necessarily just for retirement when you're in your 60s or 70s. You could potentially semi-retire. Okay. All right. Here's the chart I was talking about. Typically, retirees are going to need between 70 to 90% of their salary. You might need less, depends on your living situation, how much your bills are, right? Where will your income come from in many cases? And we're talking strictly retirement in your 60s. Money's going to come from Social Security, pension and retirement plans, maybe some income from assets. Maybe you have some property that you own with your family that's generating income, or maybe you are doing a little bit of work part-time. So all of that is going to factor into your income when you retire. What are the benefits of the plan? Well, it's easy. Money comes directly out of your paycheck, so you don't have to worry about writing a check and saying, hey, Gene, put this in my account. No, it comes directly out of your paycheck, and it's a great strategy for you to build wealth. Why? Because you're paying yourself first. Pay yourself first, then pay your bills, right? You don't want to pay your bills first and then pay yourself because 9 times out of 10, there's not going to be any money left over just in your mind. So deferred comp is an opportunity for you to pay yourself first. How much should you contribute to deferred comp? Well, that's a personal preference, depends on your goals. What are you trying to accomplish in terms of retirement or semi-retirement? But typically, folks are going to need to save somewhere in the neighborhood of 10 or 15%, right? And if you cannot afford, hey, Gene, I got to eat. I live in the Bay Area, rent's high, my mortgage high, et cetera, then cut it down to maybe 5%. That's okay because you guys all have a Sarah to fall back on. What are the plan highlights in 2026? If you're under 50 years of age, you can contribute 24,500. If you're 50 and over, in addition to the 24,500, you can invest an additional 8,000. If you're between the ages of 60 and 63 in 2026 and beyond, not only can you put in the 24,500, but you can deposit that $11,250 more, bringing your total to close to 36,000. And if you are 3 years away from normal county retirement age, and you qualify, you can contribute $49,000 a year for 3 years prior to retirement. That's called the 3-year catch up. Okay. Vesting, there is no vesting schedule. Every dollar that you invest into deferred comp is yours. Once you leave county service, you have access to it. Let's talk about investments. There's roughly 15 core investments. So if you're not interested in risk, you don't want to see your money ever go down in value, there's the Alameda County Stable Value Fund. If you are an index fund investor, you like the vanguards of the world. There is a State Street Index Fund and there's Fidelity Index Funds. They're very similar to Vanguard. Say you're interested in socially responsible investments. There's investments in here. But if you're looking to create a portfolio of small cap companies, medium sized companies, large companies, some international, some bonds, you can create your own customized portfolio based upon your expertise. The other thing I want to talk about is when you're investing in deferred comp, you can create your own portfolio or you can use Fisher Investments. That's an asset allocation tool, or Goal Maker. That's another tool. And I believe I have some slides to kind of go through. So I'll get to that. So let's put that on hold. Here are the 3 ways in which you can put money into deferred comp. So it's going to come out of your paycheck. You can invest pre-tax, you can invest in the Roth version, or you can roll over money from an outside institution into deferred comp. Okay. Here are the details about pre-tax. Real briefly, when you're investing pre-tax, it reduces your taxable income. You pay less in taxes upfront, so you get a tax break. So you defer your taxes now, you pay them later when you believe you're going to be in a lower tax bracket. So the pre-tax version of deferred comp works best if you believe you're going to be in a lower tax bracket when you retire. Now, on the flip side, if you believe you're going to be in a higher tax bracket when you retire, you'd rather pay the taxes right now. So the Roth version makes more sense. So you invest, you pay the taxes now, grows and grows and grows over time. You have this pool of cash that you have access to tax free. So that's the Roth version of deferred comp. Okay. And then there's the typical rollover. If you have money out of at your previous employer that was nonprofit 403b, or maybe you worked for a for-profit company that has a 401k, you can roll that money into deferred comp without any penalty, without any taxes. Visit with me and I can show you how to make that happen. Okay. You're in charge of your investment. Unlike a Sarah tells you exactly how much of your salary you have to contribute. A Sarah will tell you how to invest the money. They will invest the money on your behalf. They do an excellent job of that, but there's no flexibility on that end for you. But here with deferred comp, you have the ability to change the amount. You can stop the amount. You can use a fixed dollar amount. You can even use a percent of your salary to contribute into deferred comp. Okay. Oh, yeah. Here are the slides I was talking about earlier. Got a little out of order. So, if you're looking to invest in deferred comp and you need some help, there are three ways. There's a do it for me option. So, you just pay Fisher, they will invest the money. Help me do it option. That's with Goalmaker. And there's also a Fisher personalized retirement online advice, but that's where you have Goalmaker or Empower or Fisher helping you do it through Goalmaker. And then there is a do it myself option. That's the option where you're going to do all your own homework. You're going to pick the funds for you. Or some people use this option. Maybe you have a broker that you work with that you trust, then they can help you create a portfolio on your behalf. Okay, so here's a quick introduction of Goalmaker, award-winning asset allocation tool. You tell us your investor style, conservative, moderate, aggressive. You tell us the year in which you're going to retire. You get asset allocation, you get rebalancing, and you also get age adjustment. What that means is as you get closer and closer to retirement, the account gets more and more conservative. Makes sense because you don't have time on your side to recoup any short-term losses, and you're going to need access to this money in short order. Okay, here's the slide I wanted to talk to you guys about in terms of transferring money from a previous institution, right? An IRA, 403b, 401k eliminates the hassles of monitoring multiple plans, right? You can create a clear picture of your current savings. You can put it all in one place. And once we have it all in one place, it's easier for us together to kind of see where you stand and see if you're on track for a comfortable retirement. Now, unlike a 403b, unlike a 401k, you have access to this money, assuming you leave county service, you quit or retire, you have access to this money without a penalty. There is no such thing as a penalty when you withdraw. Now, are there taxes involved? Probably, but there's no penalty. 401k, 403b, you have to wait until you're 59 and a half. Okay, so the distribution options are very, very flexible. Okay, so now let's talk about the new features. Brand new, based upon the Secure Act 2.0. There's something called an in-plan Roth conversion. There's super catch-up contributions. I talked about that earlier. That's not really new because I believe that was available in 2025. There's new Roth rules for certain high-income earners. There's loans for separated employees, and there's also rollovers into the plan for separated employees. The bottom two, they are available for those folks who are currently working for the county. So you can borrow against your deferred comp if you work for the county. But in the past, separated employees did not have that feature. And rolling over into the plan, that's currently available. It's always been available for those folks who are currently employed by the county. But now it's being offered for separated employees. So let's talk about the in plan real quick. Let's talk about the in plan Roth conversion. What does this mean? What this means is, let's say you have the bulk of your money invested in deferred comp pre-tax, the regular pre-tax version, and you're really interested in converting that money into Roth money because you know that it's going to be tax-free assets that you're going to get in the future. Now, in order to take advantage of the Roth in the past, you had to just stop contributing to the before tax and then begin contributing to the Roth. But it was very difficult for your Roth balance to catch up. So now what you can do is you can discuss this with Empower or with me. Hey, Gene, I want to take some of my pre-tax money and I want to put it in the Roth. Okay. But remember, your pre-tax bucket of deferred comp money hasn't been taxed. So if you want to convert it, you have to pay the taxes on whatever that amount is. And that money has to come from an outside account. You cannot use money in deferred comp to pay the taxes. Okay. So that option's available to you, right? Convert your pre-tax money into Roth. You write a check to pay the taxes, and going forward, the money grows tax-free. Okay. Now let's take a step back. I talked earlier about contributing to the Roth. And let's say hypothetically you are 50 years old and you want to contribute the max. You want to contribute 24,500 if you remember that. And then there's that $8,000 that you can additionally contribute to deferred comp. Your objective is to put it all in the pre-tax bucket of deferred comp. Okay. Now, the new rule is if your income, previous year's income exceeds $150,000, you do not have the option of putting that catch up amount of $8,000 into the pre-tax bucket. It must go into the Roth bucket. Okay. So hopefully that's clear. If you, and that also applies to the 60, 61, 62, 63. If your income exceeds 150, you can only invest 24,500 in the pre-tax bucket. The balance must go into the Roth, whether you like that or not. So I just wanted to make sure everyone was aware of that. Okay. So loans are now available for separated employees. So if you ever leave and you want to borrow from your deferred comp, you can do that. People take advantage of that because when you withdraw money from your deferred comp, in many cases, it's taxable and you don't want to pay the taxes on it, right? But now you can borrow from deferred comp and avoid paying the taxes. And this typically happens when you leave county service and say you want to buy a car. Car costs 50 grand. You have to withdraw 50,000 from deferred comp, then you got to pay taxes on it. But now that you can borrow from your deferred comp, not have to pay taxes on it, and then you can just make payments until you pay off the loan. Okay. Rollovers have always been available for county employees, but they're now available for separated employees. So if you leave the county, you quit the county, you really love deferred comp, you'd like to roll money from the outside into this account, it's now currently available to you when you leave county service. Okay. So let's take another step back. I went through some details there. Now I'm talking to the folks who are currently not in the plan. Now I got to tell you, if you're currently not in the plan, all I ask you to do, go to the person that's the most experienced person in your department and ask them about deferred comp. And I'm fairly certain they're going to say, deferred comp's a great program. I wish I would have started sooner. Okay. So sign up, start with 20 bucks if you have to, 50 bucks, start somewhere and then just build upon that over time. Trust me, if you're tier 4, you may not know it now, but it's pretty much mandatory for you to invest in deferred comp. So you can semi catch up with those folks that are tier 2 because tier 2 retirement is a little bit more lucrative than tier 4. So you're going to need more money in retirement if you're a tier 4 employee. All right. Enrolling in the plan, just go to treasurer.acgov.org and then just click on the deferred compensation tab and then go to forms, print the page, print it out, sign it, send it in. If you need some help completing the form, reach out to me. I can help you with that. If you want to make changes to the amount you're contributing to deferred comp. Same website, go to payroll modification form, and then type in the amount you're interested in increasing it to. Okay. Once you've signed up, I encourage you to create a user ID and password for the Empower site, but just go to AlamidaCountyDCP.com, click on register, and then you can register for the website. But there's information about the plan. There's an investing page that you can take a look at, and there's a learning center. Okay. Let's see. I went too fast here. There's an app. So you download the app. You can view your account, view your statements, move money around, uh, financial planning calculators, etc. So I encourage you to take advantage of the app that Empower offers. To get in contact with us, you can either go online at AlamidaCountyDCP.com, click on, I believe it's Meet Your Plan Representatives, and then you'll see our list of folks that can meet with you. There's Mark, there's Daryl, there's myself, there's Dan, there's Jose. We're all licensed, all capable to provide whatever retirement planning advice or guidance you need to help you secure your future, whether it's you want to retire in your 60s or if you're attempting to retire in your 50s. We can help you come up with a strategy, a path to make that happen. Okay, so here's the number 855-969-4572. And with that, I'd love to entertain questions.